Welcome, everyone. Thanks for joining us for today's webinar, the One Big Beautiful Bill Review. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limberg, and Linus regularly speaks at industry events. Before I turn the floor over to Linus, we are going to vote on October's webinar. The options for the October webinar are: private letter ruling confirms spousal stretch with estate as beneficiary, or dynasty trust planning, or life insurance and tax uncertainty. I'm going to launch the poll and give everyone a minute or so to vote for the October webinar. All right, I'll give everybody a few more seconds to vote, and then we'll wrap it up. All right, it looks like the topic for October will be life insurance and tax uncertainty. Thank you for participating, and with that, I will turn it over to Linus.
Welcome everyone to today's webinar on the subject of the One Big Beautiful Bill Act. Glad you joined us today for one of our free webinars on the first Wednesday of every month. Financial professionals are welcome to come to this webinar, and today we will be discussing the One Big Beautiful Bill Act. Feel welcome to plan to join us next month, again on the first Wednesday of the month at 11 o'clock Central Time. Next month's webinar topic will be Asset Protection Planning, an Imperfect Guide. And it's an imperfect guide because asset protection planning is an imprecise science, but we'll talk about that in detail next month. Feel welcome to join us for that. And if you know of another financial professional who you feel would benefit from attending the webinar, feel welcome to invite them to join us for the webinar. So let's go ahead and talk about the One Big Beautiful Bill Act. On July 4th of 2025, President Trump signed that act, sometimes known as OBBBA, into law after its narrow passage in both the House and the Senate. The final version of OBBBA was slightly different from the bills originally passed in both houses. Congress and the Senate struggled to reconcile the differences between the lower and upper chambers, and so the final version has some slightly different provisions in it than you may have heard in the news before July 1st. The highlights that are relevant to us are much as you see on the screen. First of all, federal income tax rates are scheduled to, that were originally scheduled to sunset at the end of this year. Those have been extended. Certain taxpayers 65 or older will receive a bonus deduction against taxable income. Estate tax rules were stabilized at an amount slightly higher than the current exemption amount, and the pass-through business deduction and certain other business tax rules were retained with slight modifications. And we're going to talk about all of those things briefly during the next 15 minutes or so, and then spend about another minute at the end to discuss how you might be able to use this information to help your clients. So let's start with the income tax extensions. First of all, the federal income tax brackets were scheduled to revert to higher brackets at the end of this year, the beginning of next year. And so OBBBA extended those existing brackets and their rates permanently, whatever permanently might mean in Washington these days. The Act has language in it that extends those tax rates permanently. The standard deduction is available. It has been increased slightly for 2025 for both for all kinds of taxpayers in the different categories. And the thing that is new is this new senior standard deduction, which is available for those 65 or older starting this year through 2028. And it's a $6,000 extra deduction for those 65 or older. If both married individuals are older than 65, each would get a $6,000 deduction, $12,000 total. The good news is that's on top of the already available standard deduction. The other good news is that even those who itemize will be eligible for, potentially eligible for the extra $6,000. Now there is bad news, and the bad news is that the availability of this extra $6,000 bonus deduction depends on income. If you've got a married couple filing jointly who have gross income of more than $250,000, they will not get any part of the $6,000 new bonus deduction. Those who are close to that number will get a reduced amount of the bonus deduction. So there you go. Let's talk about estate tax. We've got, for most of us who work with clients who are wealthy, the change is mostly good news for our clients. And that is that the estate tax exemption amount has been increased to $15 million, up from just about $14 million this year. That's not much of an increase, but it is an increase. And the estate tax rate is staying the same at 40%. And also the exemption is going to continue to be indexed for inflation going forward. And so that was pretty much kept intact by OBBBA. And therefore, those of our clients who are high net worth, who potentially are worried about estate taxes, can rest assured that whatever plans they have made or whatever plans they are considering would still be relevant in light of the changes that have been made. The generation skipping tax for those who are uber wealthy trying to leave wealth to an extra generation below their kids, that exemption has likewise increased to $15 million, and it's scheduled to align with the federal estate tax exemption going forward, as it has done already for many years. For our business owner clients, there's also good news in the OBBBA, and that is the 20% deduction for pass-through businesses has really been retained with hardly any changes at all. So if you've got a client who in the past qualified for a 20% deduction because they have a pass-through business and they're in a favored category, or if their adjusted gross income from the business is limited, they should still expect to get a 20% deduction for their pass-through business income going forward. For those who are taking advantage or have been taking advantage of expensing rules for equipment that is purchased by a business, the maximum amount of the deduction has increased from $1 million to $2.5 million. This is available to mid-sized businesses really only if you've got a business that has a lot of income. The enhanced Sections 179 deduction is probably not available for a high-income business. However, the new law restores 100% bonus depreciation for certain kinds of property. That had been reduced to 60% for 2024. And if it's qualifying property, if it's been acquired and placed in service after January 19th of this year, then it should be available for the 100% bonus depreciation. So good news for our business owning clients. Let's talk about a few things that are a little bit haphazard here in the One Big Beautiful Act. First one is qualified opportunity zones. Qualified opportunity zones have been a way for people who have sold assets that generated a capital gains a capital gains result to reinvest that money in a particular kind of asset, a qualified opportunity zone, and defer the capital gains tax associated with the sale of the original capital assets. Those rules were scheduled to expire at the end of this year, but the new law permanently extends the possibility of qualified opportunity zone reinvestment as a way to manage a capital gains result, but it's different kinds of properties that will qualify for qualified opportunity zone treatment. The new rules favor certain kinds of rural area properties for QOZ treatment, and there's fairly robust reporting requirements by folks offering qualified opportunity zone investments and for those choosing to invest in them that didn't exist before. So be aware of that. There will likely be substantial regulations associated with this because there are plenty of unanswered questions with regard to the new qualified opportunity zone opportunity. The Tax Cut and Job Act, as you may remember, limited the amount of itemized deduction that a person could take for state and local taxes to $10,000. It really affected people adversely who itemized and lived in states and had property in states for their primary residence that had property taxes in excess of $10,000. That was really that limitation was a negative thing. So OBBBA has increased the maximum state and local tax deduction to $40,000 effective immediately. So for those who have high property taxes, who have high local taxes, they will have the ability to take a bigger itemized deduction. Although, if we have really high income people, married filing jointly above $500,000, the value of the deduction will be reduced to the extent their income is above $500,000. But it can't be reduced lower than the current limit of $10,000 for married couple filing jointly. And then one other thing that is of interest is that the One Big Beautiful Bill Act creates a charitable deduction for taxpayers who do not itemize. Maximum amount is $1,000 for single taxpayers, $2,000 for married people filing jointly. Again, this is available for people who do not itemize. It's going to be available starting with tax year 2026. And then another change is beginning in 2026, taxpayers who do itemize will be subject to a threshold before charitable contributions become deductible. And that is 0.5%. So you have to give away more than 0.5% before the first dollar of charitable gift becomes deductible for an itemizing taxpayer. What are the conclusions that we would encourage you to draw from these changes? I think, first of all, our clients may be interested in taking advantage of federal income taxes being on sale. The deficit is not going down, it's going up. It is likely that sometime in the future the rules will change, and because of the size of the federal deficit, income taxes will go up. And so today those taxes are relatively low, and because of that, people might ought to think about pursuing strategies like Roth conversions at a time when tax brackets are relatively low, or accelerating income if they've got a choice, accelerating income into current years as opposed to deferring into future years. Because federal estate tax rules have been stabilized, now may be the time for our high net worth people to make plans, whether it's adjustments to existing plans or committing to things they had been thinking about with uncertainty over what the estate tax rules were going to be. It feels like, at least for the next several years, that federal estate tax rules, exemption amount, and tax bracket are likely to be stable. Therefore, now's an opportune time to make plans. And then finally, for our business owning clients, whether it's pass-through or whether it's a more robust C corporation style business, there are still some incentives for investing in the business, investing in operations, and it's good news for our entrepreneurial clients, and we ought to bring that news to them if they don't already know about it. Now, at this point, I'd like to thank you again for joining our webinar.